Gold investments can be made in various forms, including buying physical gold, gold ETFs, digital gold, gold mutual funds, and sovereign gold bonds. Even when equities, commodities, or other assets lose value, investors always run towards gold. Hence, it is often termed as a safety net. Even if we look at the statistical graph of gold prices from 2000 to recently May 2025, we can see that it has been growing constantly. Now, although there have been times when gold prices dipped, it usually doesn't last for long, and it always makes a strong upturn because gold is gold. You can trust me, I'm a South Indian, and I can confirm that there is no occasion, be it a wedding, a festival, or a religious ceremony, without gold. Jokes apart, when it comes to investing in gold, there are two things you should be careful about: the returns and other important factors, such as its liquidity, storage requirements, and regulation. Let's start with returns. That is, how much will my gold grow in value? So if I buy 10 grams today in 2025 for say rupees X, how much will it be worth next year and the upcoming years? If you look at the data, SGBs have a fixed 2.5% annual return and a tax-free maturity if held until completion of the 8-year term. In such a case, the total estimated return is around 13% per annum. You're free to exit from the 5th year onwards, but if you do so via an exchange, tax will be applicable on your returns. Physical gold comes next. If you remove the making charges, storage, GST, and theft risk, it gave a solid 20% return after 5 years. Digital gold follows physical gold close by, so its returns are also around 20% before the costs. However, after considering these costs such as the GST, taxes, platform fees, the effective net return typically comes around to 12% for 5 years again. Gold ETF for 5 years has an annual return of around 13%. With gold ETF again, there is no fixed interest rate like your SGBs, and it can be taxed at the slab rates. Finally, we have gold mutual funds with a return of 10% for the past 5 years. Now, we can plot it on the table, so it will be SGBs followed by gold ETFs, physical gold, digital gold, and gold mutual funds. Although returns aren't the only way to compare them. Like I said earlier, we have other factors as well, such as liquidity, regulations, and storage rates. That reminds me, at Alice Blue, we come up with unique teaching styles to help you understand and learn finance without scaring or confusing you. And if you don't want to miss out on any of that, then make sure to hit the like button and subscribe to Alice Blue's YouTube channel to keep up with the financial world. Anyways, getting back to our video, the first one is storage requirements, which except for physical gold, none of them need. So let's just mark it immediately on the table. Gold ETFs are held in your demat account. Digital gold is stored in vaults by the provider. SGBs are backed by the government and held in demat or certificate format, and gold mutual funds invest in gold ETFs with units held in your mutual fund account. Next, we have liquidity. That is, how easily you can access your money. As in, if tomorrow I suddenly want to exchange my gold for money, how quickly and effortlessly can I do that? That is liquidity. Physical gold can be sold at a jewelry, but it might involve price negotiation and might have a lower resale value. So it is quick but not exactly effortless, hence medium. Gold ETFs are highly liquid. It's basically like trading stocks on exchanges like NSE and BSE. You can sell it during market hours and receive the amount the next trading day. Digital gold can be sold online at any time via any app or platform. The amount will usually get credited to your account within 48 hours. SGBs have a lock-in period, usually 8 years. So if you decide to sell it before it reaches its maturity, then it will be less liquid. Gold mutual funds can be redeemed like any mutual fund. It experiences a slight delay as compared to gold ETF, but nevertheless, the amount will get credited to your account either on the next or the next to next trading day. Lastly, we have safety or regulation, because apparently smartwatches can be bought from a reputable store as well as from Chor Bazaar. So, you need to be sure that your gold is coming from the right place. For physical gold, buying and selling are largely informal, so there is no real-time tracking or investor protection. Hence, there is a high risk of fraud and other such issues. Gold ETFs are tightly regulated by SEBI because they are traded on stock exchanges. Digital gold is not SEBI regulated, it is stored in vaults by its provider, so the risk largely depends on your provider. SGBs are both issued and backed by the RBI, so they're completely guaranteed by the government. Although because of its lock-in safety, it reduces flexibility like we saw with its liquidity. Lastly, a gold mutual fund operates under mutual fund regulations, which again comes under SEBI. Now, before investing, sit down for a minute and compare all the pros and cons and draw your own conclusions. And if you decide to invest in gold digitally, then just make sure that you do so with a reputable and trustworthy broker like Alice Blue. To learn more about how to open a Demat account with Alice Blue, make sure to check out this video. And I'll see you guys next time.
Investments in securities markets are subject to market risks. Read all the related documents carefully before investing.